Hi, we're going to continue our exploration of the shareholders' equity section of the financial statements, and here we're going to talk about the recognition and the measurement of shares. Before shares can be issued, a number of things have to happen. The first is they have to be authorized. We find that information in the Articles of Incorporation, which gives the corporation the legal right to issue sometimes an unlimited number and sometimes a set number of shares of different classes. This is also where the different types of classes are identified. The next step is to offer the shares for sale. The corporation has to determine a price along with the underwriters, and a lot of smart people will discuss this. What's a good price to do this? And you probably have heard about an initial public offering, and this is the very first time a corporation offers shares to the public, and a lot of work goes into that. From our perspective as the accountants, what we're interested in is when the shares are paid for, they are issued, and they need to be recorded then in the equity section. As said, there's a lot of people involved in organizing the issuance of shares. There's different costs, the underwriting costs, the accounting and legal fees, the printing costs. All of these things then use a lot of money, and they have to be recorded somewhere. But they do not meet the definition of an expense. Now, you may remember the definition of an expense. So they are decreases in economic benefits. Well, that is what happens here. However, it tells us that not included in that definition are those costs relating to distribution to equity participants. And that's the part of the definition that tells us these costs are not a current expense. So as a result, we capitalize these costs. And simply put, we debit them to the proceeds from the share issuance. So debit common shares. And sometimes, in order to make the share issuance attractive to buyers, the corporation will sell them on a subscription basis. So this is where shareholders agree to buy the shares and pay for them later. Usually there's a down payment. This then does create a receivable, and the receivable account is the share subscription receivable. So there's two accounts: share subscription receivable, common shares subscribed. ASPE requires that both of those be included in the equity section. So the share subscription receivable is not shown as an asset, rather it's included in the equity section. And you can see at this point then, since they're both in equity, it basically nullifies it. But there's two separate accounts and we keep track of it. IFRS does not have a specific rule on this, but the language around it would suggest that ASPE's method would be acceptable and is the most common method of doing it. In this case, the first installment was half, so that there's a little note down here of what's happening. 50 people accept an offer to purchase 10 common shares at a price of $20 a share. They agree to pay 50% now and remaining 50% in 6 months. So that first installment is a debit to cash and a credit to the share subscription receivable. And at that point, we still haven't issued any shares. So what happens if they never pay for the shares? Well, there's three choices. You can return the amount already paid. You can treat the amount as forfeited and transfer it to contributed surplus, or issue fewer shares. So those are the three choices. And the accounting for them is very straightforward. If we look at the little situation I had set up there, we can see that the T accounts, there was a balance here of the share subscription receivable. There was a $5,000 debit balance. And so if they're defaulting on that and they're not going to pay for them, we need to credit share subscription receivable for $5,000. As well, we had an account called common shares subscribed. It had a credit balance of 10,000, so we'll need a credit to common shares subscribed. And the difference then, if we're going to return that amount to the subscribers, is either cash or an accounts payable of some sort. If, on the other hand, we decide to treat it as forfeited, we transfer it to contributed surplus. These, of course, would all be described in the offering to the public, so they would know what they were getting into. So, same two entries: debit the common shares subscribed, credit the share subscription receivable for the amount that wasn't paid, and here an offsetting credit to contributed capital. By the way, contributed capital is the amount that shareholders provide to the corporation. And it's different from earned income, which we commonly think of as retained earnings. So the last situation would be to issue fewer shares proportional to what was paid. So in this example, really simple, they paid for half, so we would give them half the shares that they had originally subscribed to. First parts of the entry exactly the same: common shares subscribed, credit share subscription receivable, and here we would just issue common shares. And in this case, even though they had originally subscribed to 5,000 shares, we would show only 2,500 common shares issued. Now, occasionally, corporations will retire or reacquire their shares, or sometimes they convert them. We saw that those were the types of things that were common as options with shares. So when shares are purchased or redeemed by the issuing corporation, the price is very likely to be different than what they were originally sold for. And again, because of the nature of this transaction, gains and losses are booked through equity. They're not gains and losses from operating activities. So the possibility is that they will be reacquired at greater than the cost. And this is how you handle it. If that is true, the first thing you do is to debit share capital for the average per share amount of that class. Then if there's an amount in contributed surplus that resulted from cancellation or resale of shares of the same class previously, you will debit that. If there's still an amount left over, then you can debit contributed surplus for other transactions of the same class: common shares, preferred shares. And lastly, if there's still an amount left over, you debit retained earnings. Now, what normally happens, or what the most usual situation is that we will debit share capital for the average per share amount of that class and debit retained earnings. That's the most common. But watch for, in the question, some conversation around there being contributed surplus. It's easy breezy. That's really all there is to say about this. Of course, the practical application gets a little bit more complicated, but that's the rules of the game. Thanks very much for listening.